Hey everybody, good to be with you. It's Friday, TGIF, time for condors, calendars, and butterflies. This week, we're going to hit up butterflies. We're kind of doing a series if you haven't seen the past episodes. And this week, it's time for butterflies. So it's going to follow up. We had a couple sessions on calendars and earnings calendars, which I may refer to. In fact, we'll look at some of those trades, I think, if we have some time towards the end of the webcast here. But if you are interested in seeing past episodes of this webcast, I just put a link in the chat there to the playlist for this webcast. Now, I'm joined by Rachel Deshelle helping me out in the chat. I always appreciate Rachel. And I would strongly encourage you to follow us on X at BrentMooreCS, at Rachel-CS, or our X handles. Also, Rachel teaches a wonderful webcast on Tuesdays called Long Options. You know, we talk about a variety of different, what I'd call more advanced types of options trades, multi-leg options trades. But I'm not here it's not to rule out things like a long options trade, just a single long options trade, just different times for different trades. Hey, before we get too far into this, let me just thank you for joining me. Some familiar names in the chat. And if you're watching on recording, hey, we're glad to have you too. Also, options do carry a high level of risk and are not suitable for all investors. And the material today is intended for general informational purposes only. It's not an individual recommendation or personalized investment advice. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And the paper money software application is intended for educational purposes only. And just realize one of the differences between the paper money application and your live account is paper money will not assign short options early. Well, in your real account, that certainly can happen. And rolling strategies can entail additional transaction costs. All investing involves risk, including loss of principal. Past performance is no guarantee of future results. And let's see, there's no guarantee of an execution of a stop order that it will be at or near the stop price. Schwab does not recommend the use of technical analysis as the sole means of investment research. Okay, we got that out of the way. Those are interest rates. I don't know why I have those up on the chart right now. We're not going to look at that right now. But let's look at the SPX. This is the SPX. Down about 0.5% today or so. So continuing the pullback, we're right. In fact, I noticed this is the 50-day. We were below the 50-day an hour ago. Well, we've recovered. We're kind of right at that 50-day moving average right now of interest. Okay, now butterfly spreads, along with calendar spreads, iron condors, are generally deemed to be more neutral trades, right? So one of the questions that comes in is, well, when would I do one versus the other? Well, that's what I want you to understand. When would I do a butterfly versus an iron condor, for example, or a calendar? We've just dealt with calendar spreads. And given that they're all neutral-ish trades, they're all positive theta trades. In other words, time decay helps us out on all of these trades. Those are all great things, perhaps. But one difference is some of these trades are positive vega trades. Some of these trades are negative vega trades. In other words, they benefit if implied volatilities goes up, or implied volatilities go down. Calendars benefit if implied volatilities go up. Iron condors benefit if implied volatilities drop. And butterflies, where do butterflies fit in there? Butterflies fit in with that iron condor camp there of negative vega trades. So I'll abbreviate BT, okay, whatever. Negative vega. So when would we do an iron condor versus a butterfly? I'm going to try and address that today because there are some differences there between them that kind of go beyond just the Greeks, right? Okay, so here's what I'm going to do. I want to start off with the trade. Let's just I'm going to look at, to start, Citigroup. And for my purposes, I'm going to avoid earnings today. Okay, we're going to avoid earnings. Most stocks at this point of earnings season have had earnings, but there's some that haven't. And I'm going to find a stock that I'm deeming to be a little bit more in the neutral camp. Now, you may disagree. I would say, hey, look, this is looking kind of neutral to me. I mean, we had a pretty nice upward trend, but that upward trend has now moved into more of a sideways motion. There would be my take on that. Okay, so my take. Let's look at this as well. Let's go to implied volatility. Well, here's implied volatility. We had implied volatility. We kind of peaked out there. We had earnings, and it came down a little bit from earnings. But in general, if you look at implied volatilities where we are right now, which is right around that 35%, if I were to draw kind of a line there, then I realize my line's crooked, so bear with me on that. In general, we'd say that implied volatility is actually higher than it typically is. Maybe, just maybe, that implied volatility may ease off a little bit from here. So there we go. That's how I would, characterize it. So I'm gonna take the approach that this is a neutral trade, and that our implied volatilities may drop a little bit. That would tend to favor something such as an iron condor or a butterfly spread. Let's start with a butterfly spread. And with a butterfly spread, what you're going to do is you're going to do a short call vertical and long call vertical at the same time, basically. You're going to scrunch them together so the middle strikes are the same. Or you can do puts. You're going to do a long put vertical and a short put vertical. You're going to scrunch them together so those middle strikes are the same. So you're selling two of the middle strike here. Now, where's the middle strike? The middle strike is where you think the stock is going to go, or where you want the stock to go. Sometimes you can use something like a volume profile here, and you can say, oh, look, I've got, the stock right now is, it's a little higher. It's closer, it's 99.5. If I'm truly want to be very neutral on this, then I'd maybe pick a strike right around, well, there's probably not a 99.5, but maybe 99 or 100. But the stock's up here, and if I'm assuming it's going to go down maybe a little bit, maybe something closer to a little bit lower, we'll say. So down, let me just kind of pull up my, let me get rid of that. And let's look at where our peak of our volume profile. This is just showing where most of the trades took place. Okay, most of the trades took place. That's down closer to like the 96 level. That's the most trades right there, right around 96 or so. Or if you want to go down to maybe this. So in other words, I'm going to say it's maybe going to drop a little bit. So that's how I'm going to do this. So let's go to trade. Let's go, and I'm going to go out, and I'm going to go about a month. Okay. Generally, when I'm teaching these, I'm saying go between 20 and 40 days. There may be times where we go less or times where we go more. This is more or less a non-directional trade. If we pick a lower strike, maybe something like the 97 strike or 96 strike, well, if I do that, and I'll stick with 97 here, then it's slightly bearish. Stock's at 99.5. If 97 is our target, and since that's lower than the current price, I'm going to try and keep those short positions out of the money. So I'm going to make those puts. I'm going to go to the put side of the equation there. Okay, that's a volume profile, Nick, in the chat. Some others have asked, how do you get that volume profile in there? You can add that on. It's a study, and it's a study. Let's go back here. Okay, I'm going to go to that 97. I'm going to do a butterfly spread, but I've got to decide, hey, I know where my middle strike is going to be because my middle strike is going to be where I think the stock's going to go. In this case, we said about 97. What about my short strike? Well, in this case, what I'm going to do is I'm going to go down and I'm going to say something maybe around a 25-ish delta. Well, about 25 delta. There's a 94, okay? 97 to 94 here. Okay, so I'm going to go here and I'm going to, and then I'm going to make it equidistant. So if I have 3 on this side, I'm going to go 3 on this side. So 100, 94, 100, okay? So if I want to make these an unbalanced butterfly, and our middle strike is 97, I could do something like 93 and 102 or something. In other words, there's a different distance between those two sides. However, I'm not going to deal with unbalanced or skewed butterflies today. That is for another day. And specifically, that's going to be for next week. So we'll deal with that next week. But this week, we're going to talk about balanced butterflies. So I'm going to go here. I'm going to just change spread to single. And I'm going to click on butterfly. I'm going to find the middle strike, which we said was going to be 97. Now, look, the default is 96, 97, 98. I'm just going to click on buy on that. Notice we have 2 contracts selling at the 97. I'm going to spread this out to, what do we say, 94, I think. 94 and $3 distance from the middle price. So that's going to be 100. And then what I'm going to do is I'm going to right click on this. I'm going to analyze the trade, and we're going to look at this guy right here. Here's a butterfly. This is what a butterfly looks like. Does that look kind of like some other trades maybe we've seen? Kind of like a calendar maybe you've seen? Little different than an iron condor, but same principle. Now, these are expiring on December 5th, so I'm going to just make sure that's at December 6th. I'm going to go up here and I'm going to set slices to break even and see what we got. Ooh, okay. Now, I've got my break even there. I got my break even there. And then what we can do is we can always fiddle with it a little bit. How would it be different if instead of a $3 wide, maybe I go to a $4 wide? Let me go to here. And let me set my slices to break even. And now we've gone closer to a 30% return on risk on this. Okay. So did you see, I started with something, 100, 97, 94, and I modified it. That is the beauty of the Thinkorswim platform, is it's easy to tinker with things, to play with them and get something that's more desirable. When I had them 3 wide, my probability was around 20%. Now we're around 30%. Now you're going, that's not a very high probability trade. Let me get this out of the way right now. One of the downsides, so to speak, on butterfly spreads is typically they're lower probability trades. Now, there's pros and cons though. Let's think about this. Lower probability trade, what's the benefit? Why would we ever do a low probability trade? Well, look at the max gain. Max gain is around $360 or so on this. Max loss, around $38, okay? And that's that. So you can see you end up with a much bigger potential max gain than max loss. But do not, ooh, my price is locked. Hold on one sec. Let me do that. Let's do that max gain, max loss again there. Okay, $330. Thank you for picking that up, Zach. Appreciate that. $330 and max loss about $66. So here's the thing on this. Don't expect to hit your max gain. Because look, your max gain is this little point here. What are the odds the trade ends up with right here, right on this guy? It's probably pretty slim. So that's not, we're going to try and get this middle portion here. That's where we want. We're not probably going to hit that. It'd be nice. We're probably not going to hit this. So that's why when we talk about like reward to risk ratio on these, I say don't, you can think about a reward to risk ratio, but don't, I think it has limited value because realistically, it's very difficult to get anywhere near that max gain there. Okay. So there we go. So that's what the trade looks like here. Now, I want to compare this to an alternative. And the alternative I want to compare it to is an iron condor. But let me just see if there's anything here else we need to talk about on this. When we're managing these, often we'll look to manage and not try and get the max gain, but maybe set a target at like half of the max gain. If we can get half of that max gain, that would be perhaps an exit point on a trade such as this. Okay, so that's why, or maybe you don't even have to do that, maybe a third of the max gain. So Chris said, there's like a 1% chance you're going to hit that max gain. Yeah, it's like really slim, you're going to hit that max gain. So that's why we're going to get out significantly before the max gain is in our class in terms of these rules there. All right, now we'll also use some of this other management rules we use in other trades. Once we get to about a week to go to expiration, we'll get out there as well. In terms of money management, 1 to 2% of your portfolio risk in terms of the active portion of your portfolio. Also, a technical breakout. If this turns really bullish or really bearish, we'll probably look to get out of this trade. Now, let's compare, though. Let's compare to another trade that we could potentially use on this, look at on this, and that would be an iron condor. So I'm going to go to add simulated trades, and I'm going to go, again, about the same expiration. Typically, iron condors and butterflies, I'm going to do it roughly the same expiration date on these. And so I'm going to go about a month here on this. And let's just how do we do an iron condor on this? Well, the way we often do on iron condors is we'll do something like go out to somewhere around a 20 delta and sell a put, go one strike below and buy it, go to the calls, go to like a 20 delta, we'll go to 21 here, sell the call and go one strike below that and buy. Okay, and you're going to see some pros and cons of this trade. Let me go up here and let's go to risk profile. Let's look at that. I need to get rid of my my butterfly. We're not going to look at that. We're just going to look at that iron condor. I'm going to kind of smush it in here. And this is going to bring up a pro and a con on this as we look at this. And I'm going to tell you why this may not work and give you another reason why sometimes butterflies can be more advantageous than iron condors. Not always. This isn't a recommendation. I'm just trying to give you pros and cons. Okay. Mary says, what are the characteristics you're looking for a stock that makes it a good match for this strategy? Neutral stock, neutral-ish stock. You think implied volatilities may go down are the main ones. And then something where you're looking for maybe higher probability, lower probability, but potentially a little higher reward there, okay? So Chris says, basically butterflies are lower risk, lower probability, but a higher potential reward compared to iron condor. Yes, I would agree with that statement there, Chris. Now, here's my iron condor I'm looking at. Let me do this. I'm going to change this. I'm going to set slit slices to break even on this. And look, voila, it's a high probability trade. Do you see that? The iron condor is a high probability trade. But there's a challenge, and there's a reason for the challenge. One, high probabilities means your reward to risk is probably not going to be as good. Okay, so that's what we see. In this case, it's like, seems pretty extreme. What's our max gain on this? According to this, max gain is $9. Max loss is $91. Nobody's going to do that trade probably. Well, why is that so wacky? That most people wouldn't do an iron condor. And this is going to highlight one of the reasons why iron condors can be a little bit tougher sometimes. And that is, why is this so problematic? Why is the number not good at all on this? Well, let's look at our options here. One of the challenges with options is as you get deeper out of the money or deeper in the money, you tend to get less trading activity on those contracts and consequently wider spreads. Okay, look at this. 90 strike, 70 cents, 88 cents. Well, 18 cents may not sound bad, but when your option is only 88 cents, that's like 20%. That's huge. As George said in the chat, more slippage. Yes, do you see that? That's a problem. Whereas, and that's what all four, and if we did the calls, it'd probably look pretty similar, I would guess. Let's look. Hold on one sec. If I go up here to like my 20 delta, we were down here. Bid 88 cents, 101, 68 6 cents, 84 cents. So if you're wondering why that reward to risk ratio looks so bad, it's because the liquidity, when you're getting deep in the money or deep out of the money on these contracts, kind of stinks, to be honest. So that's a problem. When we were doing the butterfly, remember we're doing two contracts. Two of the four contracts on the butterfly are basically at the money or pretty close to the money at least. When you get close to the money, you're going to have less slippage typically. Okay, so that's how that works on this. Now, let me go back. Let me go back here. We said we were going to expand that out a little bit. Let me go back to the trade tab, and I'm going to just put in this trade here. Now, we could say, look, if this starts to go against us and doesn't turn, remember 97 is our target. If this starts to go south on us, then I want to get out. Maybe if it breaks support, maybe it goes below like 95, we'll say 90. If we hit 94, we're going to get out. Or if it breaks resistance, say 104, 94 or 104, we're going to get out. We can do that on the trade. But actually, let me change this because we changed this to 101 and this to 93. And I'm going to make this a first trigger sequential order. I'm going to right click on this. I'm going to create an opposite order, one to get out. I'm going to make it a market order, good till canceled. We don't want it expiring on us today. And I'm going to click on the gear and I'm going to say, we're going to get out of this if Citigroup's marks less than or equal to 94, or if Citigroup marks greater than or equal to 104. Okay, so let me do a little summary here on this, and then I want to look at another example. Okay, we're going to click save. We're going to send the trade. Okay, and I will make sure you read. Let me just put this in. Do I have a butterflies category? Yeah, right there. Make sure you read this. We're buying a butterfly to start. Okay, max profit. Theoretical max profit 335, theoretical max loss 65. Remember, short options can be assigned early. Okay, they can be assigned early. I can send that. Okay, so now Eva Depa, I don't know if I'm saying that right, says why not use the expected move? You can use the expected move. I'm using technical analysis instead. Okay, I'm using where resistance was and where support was. If you want to go to more of a probability-based measure, you can absolutely do that. There's no problem on that. Just make sure you do what you want. I mean, you're likely to have more asymmetry if you're using the probability, excuse me, if you use the technical analysis. In other words, support may be closer than resistance or vice versa. But yeah, absolutely. You can do probabilities there on that as well. Now, let's kind of summarize where we're at so far on this. We said this is a positive theta trade. Okay. It's a delta neutral trade, or neutral-ish at least. We skewed it a little bit bearish in this case. This is a negative vega trade, meaning we want implied volatilities to drop. And it's a lower probability trade, but higher ROR. And these are all generalizations I'm saying. Of course, you can construct a butterfly in different ways and kind of mess things up perhaps, or not mess things up, but change these. But these are generalities that we're talking about, okay? And why would we choose an iron condor versus a butterfly, or a butterfly versus an iron condor, given that they're both going to be kind of same on the delta front, both be kind of pretty similar on the theta front and the vega front? This is one of them. And then the other thing I would say, in general, and again, this is just a generalization, butterflies, I think there's probably more slippage risk. There's slippage risk on both of them. It's probably accentuated a little bit with iron condors, just because we're typically spreading those wings out pretty wide on an iron condor, and therefore there's less liquidity on some of those contracts out there. So that's something to take into account. So let me give you a different example here. One that's more liquid. One that a company that you're going to be familiar with. I think you're familiar with it, Tesla. Okay. Let me go back to single here. Let's go to charts. Here's Tesla. I'm going to do the same thing. Again, I still have, and by the way, there's a survey link in the chat. We appreciate your feedback. Love to get your feedback. I read, if you send in feedback, I'll read it. Here's Tesla. Again, we just came out with earnings. Am I more neutral? Yeah, I'm going to call this more neutral. I mean, we had a pretty significant move up, but since then we've been going more or less sideways since then. Here's my volume profile. Again, if you want to add that, it's a study, just go up to the little flask there and you can add it. And by the way, just side note, volume profile, that it could look different depending on what time frame you're looking at. So for example, if I'm looking at a 6-month chart, it's going to look at 6 months worth of trading and look at the volume for the last 6 months. So it'll look one way. If I look at a year chart, it's going to look at the last year's worth of volume, and so it may look a little bit differently. But over the last 6 months, we kind of have this bimodal thing here where it goes like this and this. Well, this one seems kind of, I'm not going to worry about this now. My assumption is we're going to stay in this area. So therefore, when I look at this, I'm going to look at something that's probably kind of in this area here as my target price, okay? So let me go and let me just clean that up a little bit and get out of this. And I'm going to go right here. This is where this technically isn't the point of control because technically we had one down here, but this is where the biggest spike is in the area we're at, which is right around 440. So let's target 440 as our target price here on this. So what does that mean? It means we're going to pick that as our middle strike. Remember, whether we're doing calls or puts, you can do either. You're going to sell 2 of the middle strike. You're going to buy one at a higher strike. You're going to buy one at a lower strike. And we'll spread it out that way, okay? You can, if you're going to enter this, what you can do is you can go up here. You can go, we've got Tesla. Again, I'm going to go generally about a month out. If you're struggling with liquidity, then sometimes those monthly contracts are a little bit more liquid than the weekly contracts. Tesla's a pretty liquid company though. So I'm going to go here and I'm going to go out of the money. Stock's at 432. So I'm going to go to 440. So we've skewed this. We say it's a neutral trade, but it's technically a little bit more bullish here because we want the stock to go to 440. I'm going to do two of those contracts. I'm just going to hold down the control key. And I'm going to do that twice. Got two of those contracts. Let me just double check and make sure I did that right. There we go, two of those contracts. Now, I'm going to go here. I'm going to go, let me get a few more strikes on there. Change the strikes there. And generally I start with about that 25-ish delta, something like that. And I'm going to sell one of those. I'm going to hold down my control. Now I'm going to buy one of those. I'm going to hold down my control key. Now, check out the spread. Nice tight spreads there on that. That's beautiful. And we'll go equidistance here. So if we have one that is 440, one's at 490, where's that going to put my other one? Well, that's a 50-point difference. 440 minus 50 is going to be 390. I'm going to put in a 390 long, hold down my control key. There we go. Let's analyze this trade. Here we go. Let me unlock that. And let's look at our risk profile. That's what a butterfly spread looks like. Okay. Now, let's do this. Its expiration is December 5th. Okay, so what we're going to do is we're going to set our slices to break even. I'm expecting we're going to see the same thing we saw on the other one, lower probability, about 1/3, 33% chance. If implied volatilities drop, it will help out our trade. Okay, so in other words, if I were to go here and say, well, I'm going to move these implied volatilities down a little bit on all of these, we'll match them all. So they're all doing the same thing. If you look at this, if implied volatilities drop, that purple line, it nudged up a little bit. It nudged itself up a little bit. Is the Tesla trade a bullish one? Yes, it is. Because the current price, hold on, let me just reset this here. Because the current price, which is down here, is below where the peak is. Is it super bullish? No, it's not super bullish. If the stock is here and our peak is here, we'd say, well, it's a little bit bullish. We have a little bit more room up here for this to work than we have down here. But if you expect Tesla just to go up a long ways, this is not the trade for you. This is more of a neutral trade, slightly bullish. If you are looking for something that's just more bullish, hey, maybe you consider a long call, right? To check out Rachel's class on Tuesdays on long single options if you want something that's more directional, bullish or bearish here. But that's how this trade works right now. Okay, so kind of lower probability, about 1/3 chance statistically at expiration. That doesn't factor in technical analysis or anything. Obviously, we're only doing this because we're more neutral on this trade from a technical standpoint. But let's look at our return on risk. We already gave you the caveats on return on risk there, but about 3,400 or so max gain, about 1,500 max loss, basically 2-to-1. Max gain versus max loss on that. Let's compare that though. Let's do one more. Let's check this one out because I don't think we're going to have the liquidity issues on an iron condor that we did on the other trade here on this. So let me go back here. Let's compare this to an iron condor. And I'm going to do the same thing I did before. I'm going to sell at the 20 delta. I'm going to click on the bid price, click on the ask price. I'm going to sell at the 20 delta. Click on the, that's not the 20 delta. I got to get rid of that 420. What did I just do? Didn't mean to do that. Let me get rid of that one. That was a flub. Go to the 20 delta. We're going to sell that one, and we're going to buy that one. Now what I'm going to do, so this is an iron condor. I'm going to uncheck the butterfly. Let's look at the risk profile on this for the iron condor. Ooh, this looks a little bit more reasonable here than that other one we did. Let me just kind of scrunch this down just a little bit here. And let me just make sure I'm unlocked down there. I am unlocked down there. And let's do our set slices to break even. What's our probability? Okay, 54%. Now we're talking, that's a little bit, that's a higher probability trade. What's our return on risk? The last example we did on Iron Condor, we looked at on Citigroup, it was like 10 to 1. Here it's not 10 to 1. It's not going to be great. Look, max gain 135, max loss 365. So you are definitely risking a lot more on the Iron Condor. But that's Iron Condors. If you're doing them out of the money like that, you're not going to have a positive reward to risk ratio. It's just not realistic on that. So which trade is better? I can't tell you that. But my goal here today is to inform you of the differences between these. On all trades, you need to worry about the liquidity. Double check the liquidity on the trades. But Iron Condors could be especially susceptible, perhaps, as we spread those wings out pretty wide on that Iron Condor. But ultimately, I think the biggest distinguisher on these is going to be, do you want to emphasize the higher probability or the better return on risk? All right. So let's go and let's do the trade. Okay. I'm going to confirm and send this. I'm going to put this in my butterfly bucket. I'm not going to put an exit on this. Well, I'm going to talk about managing this here and managing some others, because I want to switch gears here just for a sec on this. Let me just make sure there's no more points I missed that I wanted to say on that butterfly spread. Butterfly spreads, call butterflies, they're long call verticals and long short call verticals squished together, or you can use the put versions of the same thing. You're selling two contracts in the middle strike. And by the way, if you're looking at your monitor tab and you're looking at your trades and you're going, what kind of trade is this I'm looking at there? The giveaway is typically the two short contracts in the middle, or some multiple of that. And let's see, I think that's covering what I wanted to cover on butterflies versus Iron Condors. Let's follow up on our earnings calendars from last week, because last week we did a couple. We did an earnings calendar, a specialized calendar on Uber. We had earnings, and we bought a calendar before it, and we got out after earnings. I got out in our managing options portfolio class on Wednesdays. We got out of this trade, as well as our Pfizer trade. Well, let's see what happened on these. Let me go back to monitor. Let me go to account statement. That's order history. Let's go to trade history. Last week was the 31st. We got in Uber. for a 95-cent debit. We got out after earnings for a 110 credit. We made a little bit, not a ton, not a ton. Okay. What about now in the chat? Let me just address something in the chat. When I said it's a study, it's not a custom study. If we're talking about the volume profile here, it's not a custom study. It's a default study that everybody has on their Thinkorswim, if we're talking about the volume profile there. So you do not need a link for that. Okay, let's look at Pfizer. Here's Pfizer. We got in at 16 cents, got out at 22 cents. So nothing to write home about study, nothing to write home about trades, made a little bit, paid for commissions and maybe a little bit more on those. So those weren't spectacular, but they did, I guess, they sort of worked, I guess, a little bit. Let's go to the week before. We did calendars. These weren't earnings calendars the week before. We did one on FCX. We did a calendar on FCX, 70 cents credit, debit. And I think we're still in that one, actually. Let's take a look. FCX, we're still in that. We also did one on CCL, which we did get out of. We'll have to look at that. Here's FCX. We're up a little bit on this. How are we going to manage this? And by the way, I talk about managing calendars more in our managing options portfolio class. But generally, if we're talking about managing this, if we get under 10 days to go to expiration, we're probably going to look to roll or close the short leg on that. Okay. We have a technical breakdown on it, okay, then we're probably, like if we turn just bullish or bearish on this, remember this is more of a neutral trade, we're probably just going to look to get out. I'm going to call this still more or less neutral here. If you're looking at this and going, this is starting to look pretty bearish on me, you'd probably just exit at this point and get out of the trade, okay? Or if you've made almost all you can make on the short contract, look, we sold this short contract for 175. It's still worth half of that. So we still have a bunch more to make on that. So we're just going to let that sit and cook. Right now, our theta is still positive on that. We're making money, everything else being equal, because of time decay on that. Okay, last one to look at here was, it was on 10/24. We did a calendar on FCX. No, on CCL. We got out a week later. Why did we get out? Okay, so we got in on CCL for a 35-cent debit. We got out for a 30-cent credit. So we lost a few bucks on that. Now, for me to see, I need to, this is where, by the way, it comes in handy to have an order history as well. Let's see what our order was that we put in on that, on CCL. We said, this is our closing order on CCL. If CCL marks less than or equal to 27.75 or 32.25. 27.75 or 32.25. Let's look at CCL. So it seems like it made a big move on us. We got in on the 24th. Yeah, I think it got out right here. We got out here. Yeah, we got out right here. So we just barely peaked below it. It then went up. The good news is this. You know what? For it to make the slightly bigger move, it got us out and we lost just a minimal amount on that trade. So that actually probably worked out fairly well there. Okay, just a reminder to everybody, we have a survey link in the chat. We appreciate your feedback on that. Let's see, let me do one more question and then we're done. Brent, I have a question. What time of books are those behind the, I don't know, David. I'm not sure which ones you're looking at there. So Um, uh, um, what, what time of books are those beyond the brown one? I don't know. Oh. Those are, I think, just some classics there basically on that. So, hey, everybody, thanks for joining me today. I appreciate you. Rachel, thanks for helping me out in the chat. You're awesome. Appreciate you. And everybody, coming up next, we've got market and sector analysis. Stay tuned for that. Make sure you subscribe to the Trader Talks channel on YouTube. And everybody, we will see you all same time next week. Bye-bye, everybody.